I'm more worried about a stagflationary environment than I am, oh, we have a recession, the Fed pumps money and we get out of it. I don't see how we can continue higher inflation, higher long-term rates, and there's not a lot to bring GDP up commensurate or better than that. I think we're going to have kind of this proverbial flat decade.
All righty, folks, we need to have a discussion. Did the Federal Reserve make a disastrous mistake by cutting 50 basis points? Or has the rise in the 10-year and subsequently mortgage rates, does it tell us something different? Is there something lurking behind the scenes? Or is this simply yet another mistake by the Fed? We're going to have this conversation with the one and only Anna Kelly. How you doing, Anna?
I'm doing great. Great to be here with you. Fun conversation.
Yeah, fun, important, lots of twists and turns. Again, folks, if you don't recall, about 3 weeks ago, mortgage rates were about 6.1. The real estate market, the mortgage market was starting to feel better. We had a refi boom going on. Even people in the commercial real estate market were starting to get starting to take a breath because rates were going down. And fast forward 3 weeks, we're not there anymore. It is a vastly different market. Mortgage rates are now over 7% and going higher based on the 10-year note today. So disastrous Fed mistake, or could the rise in rates be telling us something different?
Yeah, I don't think it was a disastrous Fed mistake. I'm not on the side that says, whoa, inflation and GDP are both, better. Inflation's supposedly worse, like going a little higher, and GDP better, and therefore the Fed shouldn't have cut rates. That's kind of the mantra of those saying that they made a mistake. The reality is, if you still look underneath the hood, and this is where you and I talk all the time, like the headline number people need to understand is not what's important. It's the digging under the hood to see what is causing those headline numbers to be there. And so 2 very quick things on GDP and on jobs, and then on inflation. If you look at trueflation.com, they really track very, very closely to real inflation. It's actually still coming down. And so we're in that below 2% to below 2% range. I haven't looked at it the last couple of days, but I think the Fed is on its way to, in the short term, and this is the key, in the short term, lower inflation, hitting its inflation targets. The second thing is the job creation. And very similarly, Michael, I didn't know in the first couple of days till I saw the data, very similarly to what we saw at the end of last year, the fourth quarter of 2023 into first quarter of 2024, is if you look at where the jobs were created, guess what happened again? The government hired government jobs and healthcare sector jobs. And healthcare is one of those industries that's considered the most recession resilient, one of the most recession resilient. So when you see government jobs make up more than 10% of new jobs created, it's almost always an indicator that a recession is on the horizon and the government is hiring to try to pump money and create jobs into the system. We have more than 25% of jobs, again, created by government and healthcare jobs. But if you look at the aggregate of the private sector job creation, it's actually negative again. And so it tells you again about this very bifurcated, like word of the year is bifurcated for me, right? This bifurcated economy where the headline number looks great, but the government is spending money to keep GDP propped up. And that also is somewhat inflationary a bit, right? Because you've got more jobs, people are going to go spend more money. As the stock market goes up, people have a lot more money in equities than they have historically. So they see the equity markets doing fine and they think they can spend a little bit more. So that also keeps retail spending up, which is another number that just came out that made people say Fed has made a mistake. But if you look at the retail spending, 2 different things on that. One is that the level of spending is ticked up a little bit, but they're not buying more stuff. The cost of everything just is more. The other thing is the top 20% of the economy, top 20% of net worth and income is spending more than 40% of spending, of consumer spending right now, which is off the charts, way higher than it normally is. And so I think you have this very bifurcated economy, like we've been saying, where the wealthy are continuing to spend, the government is continuing to spend, and that at an aggregate is keeping those headline numbers higher, making people think the Fed made a mistake. But the consumer is the economy. And again, when 70% of the consumer base is living check to check. Their debt is tapped out. They are not going to keep spending. I think there is still pain under the hood. And the beige book tells the Fed in all of those Fed districts that there is pain in many, many sectors of the economy that always leads to recession. So will we have a recession? I don't know. Our headline number, if it keeps GDP just above where it needs to be so that it doesn't go negative for 2 quarters, we won't have one declared. But then the other thing is what happens in the election and where the election goes. And you and I know we're neither of us are very political, despite what some people might say, right? If you have an opinion about the economy one way or another, you're either a MAGA doomer or you're like totally, libtard in the social media comment world. But the reality is elections have consequences, and depending on which parties get in, especially if there's a sweep red or a sweep blue in terms of Congress and presidency, that could create a lot of different outcomes. And those differences make the bond market more nervous about long-term horizon. So regardless of if we have a recession in the short term, both parties are going to spend money. But what happens in the next 5 to 10 years, which more drives those long-term treasury rates, is very uncertain. And the uncertainty is what has the bond market going crazy, going higher, treasury rates rising despite the fact that the Fed is trying to cut rates. Basically, the Fed has lost control of the bond market in the long term, but it's very complicated.
Yeah, I've spent a lot of time the last 4 or 5 days kind of trying to answer the question for myself. Fed cuts 50, and I don't think there's any question the Fed's on a cutting path, right? This wasn't a one and done. So more cuts are coming. You can argue when, but more cuts are coming. So I'm on that side. And then we've now seen the 10-year note go up, I don't know. We've seen mortgage rates go up 100 basis points.
It's crazy.
So I've been trying to answer why might that be. And again, the other wrinkle that maybe not a lot of people realize is the bond market is massive compared to the stock market. Right?
Much larger. Yeah.
Right. The bond market is often called smart money. So I've been trying to dig in and trying to figure out what is the smart money telling us. Then I go ahead and watch an interview with Paul Tudor Jones, Tudor Jones, and then Stanley Druckenmiller.
Yes.
Back-to-back days they came out. And both of them essentially said, right, inflation is the only answer, right? Inflation is the outcome that's coming.
Long term. And that's the key. That's the key. Yeah.
Yeah. Both of them talked about commodities and hard assets and all of those things and don't own treasuries and things of that nature. So again, after all of that and many more hours, this is what I think's happening. And I've never said this before. You and I are having this first conversation. I actually think what the bond market is telling us is the odds of a short-term recession have significantly deteriorated, right? They were set up, summertime for a near-term recession, probably second half of the year, Q1. They saw a recession coming. I think what they're looking at now is, again, we talked about the election. What's going to happen? Both parties are going to be spend. And it's hard to have a recession when, the government's spending that way. And so I think what's actually happening is the smart money is saying recession odds down. So let's get out of bonds and let's move into commodities. And I saw just this morning, just in the last, 10 days or 7 days or so, the commodity funds have seen a tremendous inflow. So I actually think what's happening is the smart money is saying Anna and Zuber are wrong. There's not going to be a recession in the short term. Maybe it's just delayed or punted, but I don't know. I just wanted to share that with you because it's certainly different than what you and I have been talking about, but maybe we're just wrong and there's no recession coming.
Yeah. I like when we disagree, right? Because we can't only listen to stuff that feels like what we think. And that is something that I'm really careful. Like I listen to as much hopium news as I do like doom and gloom, right? I really don't listen to much that's really on those extremes, but I listen to a lot of economists like you and a lot of billionaire hedge fund managers, former and current, a lot of Fed insiders that have worked for the Fed, worked for the FDIC, like old school economists, and then newer economists who are like modern monetary theory trained. And they have very different outlooks about what's going to happen.
Sure
but
do.
What I will say that I think is really important is if you look at the 2-year and the 10-year, those are kind of the telltale of what the bond market's thinking short term or long term. 30-year rates, obviously 30 years, it's really hard to anticipate where things are going to be in 30 years, which is why you're supposed to get a much higher rate for those 30-year coupons that you're holding through all this uncertainty. But if you look at the 2 and 10, the 2-year hasn't gone up precipitously like the 10-year. And so when I listen to different economists and then I see where are the actual numbers that we look at on the yield curve, the 2 and 10, the 2 is more indicative of short-term recession. The 10-year is more indicative of where are we beyond that 2 to 3 year period. And as you and I've talked about, an average recession is about 10 months. Sometimes, 18 months, and if they're really bad, longer. And then you've got about a 2-year recovery period. In a really bad recession, it's about a 3-year recovery period before you have an expansion. So we're kind of in that 2-year treasury is, do we have a recession or not? And is the recovery over? And as long as you think that it's a shallow recession, so I'm going to say it doesn't mean necessarily they think there's no recession or a soft landing, but if they think it's going to be shallow or we're already partially through it and we're going to come out of it not deeply scathed and a recovery is kind of vanilla, boilerplate average, then your 2 years going to be okay, even if you think there's a recession. And I know a lot of investors do think we're going to have a recession because they dig under the hood like you and I do and say, yes, the headline number is high. But they are talking more and more about, like Jamie Dimon, not necessarily recession, but they're still very concerned about stagflation, this kind of rolling recession idea where different sectors are recessionary. And we are clearly in a housing and a manufacturing recession. They are recessionary. We are clearly in a middle class, lower class recession. They are recessionary. But yet the headline number that kind of drives rates is aggregate okay. So I don't think that they're saying recession is off the table, at least not a lot of economists and hedge fund managers that I'm listening to. What they're really talking about, their concerns are, is after this next couple of years, how are we going to get out of a more inflationary environment? In other words, whether inflation stays down near 2% or not, whether we have some deflation, some recessionary type conditions, over the next several years, what is the US going to do? And whether it's the far left going very green everything and cost of energy goes up and infrastructure costs go up and they spend there, or whether it's the far right that has major tax cuts for corporations, yada, 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 less tax dollars come in, both parties are looking to spend to the wazoo. Neither party is running on fiscal conservative principles. And what happens is, to your point, when the government is spending a lot of money, one, it does put money into people's pockets. It's just whose pockets, which party, whose pockets, the richer first that trickles down, or the poorer first, and you hope that you can tax the wealthier, right? So either way, some people get more money, they spend more, and that can keep the economy humming and keep GDP just above inflation, which is what the governments have been trying to do for 40 plus years. And they've done it fairly successfully with some blips in the economy and economic cycles. But essentially, if both parties are going to continue to spend, and the reality is there's only about 8 to 12% of the entire budget that's even discretionary for Congress to fight over. 88 to 92% of the budget is fixed. And if we keep spending money, our debt keeps going up. The only solutions for government to get out of significant debt are to cut spending, right? Which again, there's not very much that they can cut. They really have to raise tax revenue, or they allow more inflation to inflate away the debt that they're creating so that they're paying it off in the future, where today's money is less worth something than it is in the future. And so all these economists that I'm listening to, unless they're modern monetary theorists, they're the newer guard, they're saying the only solution is the US creates more inflation. And we're in an era of rising conflict with, China, Russia, Iran, etc. And if you have rising conflict, there's a higher chance of war, different types of war, which again is more government spending. So we're going toward deglobalization, and the deglobalization to bring things back to the US is initially extremely inflationary because it costs a lot of money from the government and the private sector, and that's going to cause higher inflation in the future. So that is the issue that I think is driving the long-term interest rates that impact mortgage rates, for example, that regardless of what the Fed does in cutting short-term lending rates, the problem of more inflation in the future makes smart money say, there's no way I'm locking up my money for 10 years plus in an era where that seems to be the only path forward. So I need a higher coupon on that bond, on that treasury, in order to have some kind of risk premium on my money and make a return that is commensurate with the risk. So I just disagree with you on the short term versus long term in terms of what the smart money is doing.
Yeah, again, I'm just trying to play all this out because again, that is a wild move, right? 50 basis point cut and the long end goes up. I do agree, and we've been talking about this for years, and it's never probably been more true, or at least more evident. Inflation's a feature, not a bug.
Yes.
Right. It's become hopefully painfully obvious. The second thing that I think is now becoming painfully obvious is asset owners are better than asset renters. Right?
Yes, for sure.
There's, again, who's quote unquote winning. We're seeing that wealth effect, right? Whether it's stocks or even crypto this morning, Bitcoin over 71,000. You've got to do all you can to get to own assets.
Right.
It's hopefully never been more obvious.
Absolutely. And real estate is one of those things, as well as, gold and silver. Look at gold and silver prices. I mean, I started buying, a lot of gold and silver as an inflation hedge, going, how long is this inflation going to last? But there, it indicates when you have everything up, equities are up significantly, bonds are up, generally. Real estate values are up generally, other than commercial, because it's, based on the interest rates right now. But gold and silver, crypto, it's everybody is looking for a place to put money and hope for return. So we're still not in this like fear cycle of everybody's afraid, but there's enough fear that these hard assets are going up in value, like silver and gold.
I didn't even notice
consumer sentiment numbers are higher today, and so
I saw that.
It's the consumer is not necessarily the smart money because they're watching headline, right? But inflation means that everything goes up in value. Generally speaking, again, I was one of these like hurting because I have so much commercial real estate, and commercial real estate should go up with inflation. However, when you're very short-term interest rate driven and you have inflation, that devalues some assets. So that's why it's important to have residential real estate, commercial, gold and silver, anything that's hard that generally goes up in value with inflation. So it's kind of an inflation hedge where people are starting to get nervous about equities, and a lot of money's moving out of the equity market into the bond market. So that's another interesting thing to watch.
Yeah, I hadn't seen silver in a while. I own a couple hundred ounces. It's at $34.54 as of right now. Gold, shout out anybody owns gold, almost 2,800.
Right.
Pretty crazy. So again, I think there's just when I look at 2025, this is the setup I see now, and I don't say this with any pleasure. This is not a great setup for 2025. It perhaps could be the hardest year that I have seen since 1981. Right. I was a young kid in 81. It was nasty. 81 was for our family. So we're going to have higher rates than most people thought. I think 7% has a great chance of being the average mortgage rate for the year. Right. I'm calling that early. Wow. I think that has all kinds of ramifications. I think there were home builders that 5 weeks ago said they were going to build, I'm going to make a number up, 1,000 units when they thought rates were 5.5. They're probably in boardrooms right now going, we can't do 1,000 homes. We're going to do 550 because it's an entirely different market at 7 versus 5.5.
Yeah, I will say though, on the commercial side, the rates are lower. They are. Sure. They're lower than residential. So we're not seeing that big uptick in short-term rates because most home builder loans are only 2-year construction loans. So they're much closer. They're based on SOFR, but they're much closer to that 2-year treasury rate plus a very small spread than they are the long term. So I have people in my network who are excited and they're starting to build, and their rate is variable, for that 2-year period. And so if rates are cut further, despite what long-term rates do, they could be in an okay position. The question's really going to
That's good to
be,
know.
for them, do they think we're going into a recession or not? Those that are building and doing the deals don't think you're going to be in a recession, or they think it's going to be short and you'll be out of it. And then people are going to rent, the buildings back up. That they're going to pay top dollar for rents again. So there's definitely some beginning of optimism in all of commercial real estate. But
I
will
don't know.
tell you,
It'll
those
be
that have
weird.
been in it longer are still for the most part, Michael, pencils down, because the lending markets haven't changed significantly. And so even though rates are falling, the LTV that we can get on commercial loans is significantly lower. And these regional banks that were giving us construction loans, I know because I'm in the business, they're mostly pencils down, because there is still, and you mentioned 81, and I'm just going to go a little further into the 80s. I still am not convinced, and no, this isn't because I'm a doomer, because I'm not, but I'm still not convinced that we're not going to have more bank failures. I think that there's still, the higher rates are, the longer, the more risk of that, more bad debt being written off. There's been a lot of regional banks that did like we thought they might. They've kind of kicked the can and given a 1-year extension, hoping that rates are far enough down, but they can't do it for much longer from a regulatory standpoint.
Yes.
And so, we actually saw another bank failure last week. And, the FDIC hadn't coming into the rescue for those that have larger deposits this time, like they did for SVB and Signature Bank, et cetera. So I think that the issue with commercial real estate, even though there's some optimism, is that the primary lender for commercial real estate, by and large, they still have fear and they're not lending, which makes the projects not pencil even at a slightly lower interest rate. So I think you're going to have some pause in construction for a bit longer.
You're that is one of the unfortunate realities that I see in 2025 is more bank failure. So we'll get to that. So again, higher cost of capital than people were planning for. People made plans 6 weeks ago. I suspect a lot of them have to readjust. That's just been such a violent move. And again, a home builder, maybe they do have cheaper rates on the construction loan, but they still got to sell in a 7% environment.
Right.
In my story. Now, again, we know that home builders are unique because they have the ability to buy down. They have the margins. So they're still going to be okay. I do hope that builders, if rates stay in the 7, actually change the product mix, right? To maybe more entry-level housing, because that's what we're missing. That's more of a
they
hope.
are.
Yeah.
At least in my region, it's smaller homes.
Awesome. So that's first. Second, let's go to individuals. I think a lot of individuals have been enjoying the spending, and a lot of them were hoping for lower rates so they could, refi debt, consolidate debt, whatever it is. That's at 7%. That's not as likely. It's certainly not as much.
Right.
So I think there's going to be a lot more personal bankruptcies. Second, I think unemployment, unfortunately, is one of the outcomes because of the next point. I think unemployment goes up, but more importantly for the individuals, one of the nasty things about 81 in my family was my dad was unemployed, I think 10 months out of the year because it was hard to find a job. Yeah. I don't think unemployment at 81 wasn't horrific, but if you were unemployed, you were on the rolls longer. So durations got stretched out.
Right.
That is a really big fear of mine, is that if you happen to get a pink slip through no fault of your own, company acquisition, company shutdown, whatever, durations are going to be expanded for people that get unemployed. So that's a nasty fear of mine. And maybe that's PTSD from 81. Second, I think there's a lot of businesses, small and mid-sized businesses that are not profitable at today's interest rates. And a lot of them operate on short-term debt, and they're not going to be able to, quote unquote, roll the debt. So I think there's going to be a lot of pain there. And then commercial. I think commercial started to feel better as rates went down. It started to feel like, hey, we might be able to get out of this. It's not going to happen at 7. We have a very large bank. I forget who did the analysis. It was in, I want to say Wisconsin. 49th largest bank now is in trouble because of commercial real estate. This extended pretend, this 1-year add-on, if we're at 7%, it's not going to help. We're going to see a lot more bank failures. We just have to. We're going to see a lot of, it's one of the, and we're going to have LPs recognize losses, right? Because this is going to happen. It's, in all of that, we still may not have a recession. We will just be recognizing losses.
The thing that I think everybody's kind of asking the wrong question. Like, are we going to have a recession or are we not? Right. And what the economists can say is that the conditions are not as good as the headlines say. And so we don't know when is the next shoe going to drop and what is the thing that's going to spark it to be, now we have officially a recession. We don't really know. And again, the government spending kind of keeps things going for a little bit of time. But the reality is there's so many sectors of the economy that really drive growth in the economy. That's real growth, not, when the government creates growth, because the government is inefficient in operating the sectors that they're spending money on, it doesn't produce as much effect of trickle down for everybody as growth as real spending and productivity, such as manufacturing, right? And so what we've seen historically in the US is that most of the production has been driven by production or manufacturing, although that's kind of come down and technology is kind of taking over some of that, but also in housing and construction and then in healthcare. And so healthcare remains resilient. As we get sicker and sicker, healthcare is going to make more and more money, right, over time. And as we live a little bit longer, you hope, and there's different stats on that. But when housing, Michael Kantarowicz has a framework that I've mentioned a couple of times on the show called the HOPE framework. And it basically shows that housing leads the economy, and then orders manufacturing, okay, then profits for all sectors, and then employment either goes into high unemployment or not. So recessions kind of follow housing, orders, profits, employment. And we're in a housing recession, and it's only going to be worse if rates are longer, like you said. We're in a manufacturing recession. Profits and earnings misses are happening, especially in the small business sector. But this is another one of those bifurcated economies where, certain corporations are still doing well. And because of Fed forward guidance, they knew we better refi everything while we can. And a lot of them were able to refinance into low debt or raise, stock buybacks and things of that nature. But employment's ticking up. And so even if you don't have global recession, US recession, you have sectors that are recessionary, and it's the most important GDP driving sectors that are already recessionary. So the question is, at what point is there enough government spending and healthcare spending to keep these recessionary conditions rolling sector by sector? And that's why things like stagflation, Michael, are so much harder for the Fed to pull out of than even a recession. Because it's like there's not really enough growth. There's still pain for small businesses. There's going to be small business layoffs. There's going to be, to your point, the people in those sectors that can't find work without moving, because production and housing are often those jobs that you can't do remotely and work from anywhere and go get them. So if you're in, and healthcare similarly, but if you're in tech or you're in things where you can work from home, you might be fine. But how long can you go before you're in a deep recession when the dominoes just keep falling? And then you've got liquidity, banks drying up, because again, not just commercial real estate, but with the bond market, higher bond markets, how many of those banks are still holding some of their bonds on hold to maturity, and they haven't had to move them to market and recognize those losses? The longer those interest rates stay high, that the Fed is not able to control because of the bond market, the more chances that the lenders that the government relies on, the regional banks, to pump money into the system, to give small businesses loans, to give people loans, that money starts to dry up. And so I'm more worried about a stagflationary environment than I am, we have a recession, the Fed pumps money and we get out of it. I don't see how we can continue higher inflation, higher long-term rates, and there's not a lot to bring GDP up commensurate or better than that. I think we're going to have kind of this proverbial flat decade that Jeremy Grantham was warning of, Ray Dalio was warning of, Charlie Munger was warning of. It's going to be tougher out there. It's going to be tougher for my kids than it was for you and I. And so in some ways, the best case scenario is we get the recession over with, and the government tries to get us out of it. And we have assets that'll go up as the inflation starts to happen. The worst case is kind of, and again, it's not just me, but go listen to Jamie Dimon. He's a smart, he's a smart cookie. And he's very concerned about the overall health of the economy. And again, that's just the reality. But the good news is there's still money to be made. The question is, okay, if it's bad, what do we do? Where can we still find opportunity? And I think that's what we always have to come back to. And that's why, one of the reasons I love doing the show with you, because we're not here to just say things are tough. We are in a crazy, historic in our lifetime, once or twice in a lifetime kind of economic funk that is lasting more than a few months, that is taking time, and people are impatient and they're like, how can I make money? Where can I make money? I'm giving up on real estate. I'm giving up on everything. And that's a big mistake, because when things are hard, that's when there's big opportunity. And I still see opportunity. There's opportunity in affordable housing. There's opportunities where if people can't afford houses at 7% rates, Michael, there's the sellers that are selling are motivated. So make a deal work, use seller financing, try to get interest only loans, even though that can be dangerous, you got to know what you're doing. But interest only loans, long-term loans, steal it on the basis. I mean, that's where you make money, is on the buy. And there's a lot of properties that have been on the market once, twice, and still not sold. And those are the motivated sellers. So go make a win-win, be good to people, and keep doing deals, because owning assets like houses, I mean, I bought a single family house, and I hadn't bought a single family house other than vacation rentals in several years, but I bought a single family house in a really great market that's going to do well, even if we have, a lost decade, for example.
Yeah. I think there's, again, I think one of the things I think about in back to your comment about banking crisis, I don't know if people remember this. We haven't talked about it in a long time, but the savings and loan crisis of the 80s, that was not 1 year. It wasn't even not 4 years. Years. It was almost a decade.
You're right.
And that's kind of what I see coming if we do have higher rates. Is it's not going to be Wile E. Coyote over the cliff and just falling. It's going to be like, oh, that bank went. 6 weeks later. Oh, that bank went. Oh, 4 weeks later, that one went. And this could be, death by 1,000 cuts. So I think that's absolutely one of the things that I fear. The other thing I fear is the malaise. Yes. I really do. I think the next couple of years could be just yucky for a lot of people that just kind of get stuck in the malaise. It'll be like walking in mud, like deep mud, but you can still make forward progress. And your point,
for sure.
I keep telling people, you make your money when you buy, right? Everybody thinks price, but think terms, right? You can get so creative when buying real estate. And there's a saying, right? I think Warren Buffett's often credited with this, right? Buy when there's blood in the streets. But that's not the full quote. The end of that quote, even if some of the blood is yours, right? There's a lot of big players. Yeah, there's a lot of big players that did what is going to turn out to be shitty deals or terrible deals. But they're doing bigger deals now, right? There's a lot of people in the game. And then I just want to pivot to Ken McElroy. I watched a video with Ken McElroy. He was in my backyard of Henderson, Nevada, I don't know, a week or so ago. And he just picked up an apartment building. I'll use rough numbers because I don't remember the exact ones. This apartment building is about 5 years old. It last traded 2 or 2.5 years ago at $150 million. Again, that's a round number. He just picked it up because, again, short-term debt, sellers had to sell, everything we just talked about, for under $100 million. So again, what I want people to realize is Class A is starting to trade. There are being marks. Now, so again, if we get enough of those, that will force banks to recognize, and again, could lead to failures. What I don't yet see is Class B and Class C trading.
Right. There's an easy reason for that, right? Because Class B and C are generally small syndicators. I consider myself a small syndicator. I'm not a $1 billion hedge fund. Hedge funds want Class A brand new because it's the lowest risk for a risk premium. So when you go up the risk reward ladder, Class A trades at about a triple B bond. It's not as safe as a 10-year treasury. And there's a little bit more risk, but because it's new, it's generally built in a really strong local area with high incomes, with lots of job resiliency. So you have less people defaulting and not paying rent, and you have people taking better care of their property and less deterioration. So they're buying that thing to hold it for 5, 6, 7 years, usually max, and they're just adding it as a safety part of their portfolio. So when there's big money that has a lot of money coming in, especially these big funds, they can go out and they can pay cash and they can get a big discount. Syndicators have to raise money from investors and go borrow money to buy those things, and they can't afford the class A that they're competing with hedge funds. And so they're going in and they're buying class B or they're buying class C. And the syndicators are the ones that are, even very experienced, Michael. I mean, I've been in real estate for over 25 years at this point. We're lucky to get 55% LTV, which means we've got to raise 45% from investors who are spooked, who don't know, the level of risk. They still want 15, 18, 20% annualized returns. You cannot make a number pencil for anywhere near the debt that a BC apartment has on it. And therefore the seller can't sell. They just turn it back over to the bank, and the banks will just hold on to them as long as they can. They don't like to be operators, but they don't want to sell for a huge loss, at this point. So,
well, what I think is happening in Class B and Class C is exactly what happened in 2009. Is we have operators we have owners, let's just call it what they are. We have owners right now who realize they're upside down. And the bank is saying, hey, I'll give you 6 months, but you've got to try to sell the building. So again, what are they doing? They're selling it for what they paid. Not because that's the value, but that's because where they're whole or almost whole.
They can't sell it for what they paid, Michael.
Exactly.
That's the issue. Yeah.
That doesn't mean they can't list it there.
Right.
And they are. I'm seeing it.
For sure.
So just like last time, this is what will happen. These buildings will start to deteriorate in a huge way because the owner is not making any money, and the owner knows at some day they're going to lose it. And this is only going to get uglier. It could take 6 months. It could take 12, but there are going to be plenty of Class B and Class C properties that sell for 50% less than the last purchase. It's just 9, 12, 18 months from now. And again, I have seen this movie before. There's a building that Olivia and I still own today. It was originally, this is 15 years ago, it was originally listed at 1.44. Why? Because the seller bought it for 1.44. It was never worth 1.44 at the time. That building was held on for 18 months because the bank was just hoping beyond hope a 1031 exchange or something would get them out of it. It didn't. 18 months later, that solid Class B asset was a completely slumlord, destroyed property that we bought for 50% off. So we bought it for $700,000, no money down, just, a $50,000 deposit for escrow for repairs. This is coming. It just takes time. Everybody wants it now.
Right.
This is just going to be a slow bleed. And then the last thing is, there's a lot of LPs that got into 22 and 23 vintage or 21 vintage. Your money's toast. It's gone. I feel bad for you, but it was a bad deal the day you closed. It's a really bad deal now.
You did deals with people that have long-term rates. That's the key. And a lot of them did.
That's not what happened. Yeah, like 80% of the vintage was 2-year IO bridge debt. I mean,
I know.
Goodness.
I didn't do any of that because I learned. I did that rewind and said this does never end well. So I'm thankful that I didn't do that for both me and my investors. But there's definitely pain, and I think I like that you started with buy when there's blood on the streets, even if the money is yours. Like commercial investors have been rocked by what's happened over the last couple of years, both the LPs and the GPs, which makes it harder to raise money. And, there's lower LTVs. And so those that have the wherewithal to say, I can look beyond, a year or two and see what they think the risk is in the longer term. I think those that are going to continue to do deals, myself included, are those that really have the experience to say, I'm going to buy this thing. I'm going to buy it at the right basis. And then you've got to have a longer term hold perspective. And that's a big shift, in a lot of the thinking where in an expanding economy, a growing economy, a rising tide lifts all ships. And so you try to churn and flip the apartment building or flip a house, in an expansion in 2 to 3 years and you get out. A house, it's a few months, right? Apartment takes a couple of years. But when you have a contracting or even a stagnating economy, if you can't bank on values being higher, the economy booming, people being able to afford better rents, you've got to be able to get longer term loans where you're holding those things and saying, regardless of what happens in an economy in the next couple of years, usually over the long term, you can weather those things. And that's where you hold assets and inflation happens and they go up in value and people's wages grow, on paper, at least on a non-inflationary adjusted basis. And so, I'm looking at opportunities buying smaller apartment buildings, smaller than I did before. I started out with 4 units and then I did 10 and 20 units and then 100 units. And then, our biggest building was about 500 units. But one of the things to recognize as a smaller investor, like a lot of your listeners, is those that had the really big apartments could get, and a lot of them do have 10-year Fannie Freddie loans that are non-recourse. And so they're going to try to extend those things or hold on to them. The smaller apartment building owners, like 20 unit, 30 unit, 40 unit, 50 unit, a lot of them went to a regional bank and they are not non-recourse loans. So those sellers are going to have to sell. And sometimes you can go into that same bank if you have wherewithal and credit and some reserves and experience and say, hey, I want to do the loan with you. You've already got the asset, but I'm a better, buyer, borrower, et cetera. And you can get a good price and get financing on them. And so I'm looking to buy some smaller buildings, smaller than, 100 units, because we don't have a lot of bigger than 100 unit buildings in my areas that I'm in that are not, class A and way overpriced right now. But if you can go into those distressed landlords that are going to lose properties and they are not non-recourse loans. So it's better for them to take a little hit on their credit by giving you a small haircut than it is for them to have the whole loan written off and against their credit. So I'm looking to buy properties and apartment buildings at a discount and then holding them for 10 years, underwriting at least a 10-year hold, because that gets you through a lot of the lumpiness in the economy, gets you through some inflation. And then at the end, you're holding an asset where your mortgage is really well paid down, you're cash flowing more and more, and the value is going to be higher. So this is not a doom report. It's here's where there's opportunity. Where is there distressed sellers? Where are there distressed markets? Short-term rentals, commercial real estate. That's where if you have the wherewithal to run in, despite having a little blood and still licking your wounds, you can do really well in the future. I do believe that.
No, I think that is essentially my playbook with one little twist. If I could make a wish, it would be I will just like I did last time. I'll 1031 out of overpriced homes into distressed commercial real estate with none of my own money. I'll just use equity from the house and throw that into a 5, a 10, a 20 unit. I'm looking up to 50 units at this point, but yeah, I think that's 25 and 26. I think it's going to be years of this, individuals and lenders making choices. It's not going to be Wile E. Coyote where it all happens in a moment.
Right.
So lots of opportunity, do the work, network, meet new people, get creative. This is going to be a wonderful time for a very small subset of our economy. Probably a lot of my viewers understand this because we talk about it every day.
Right.
The opportunity that's coming in a buyer's market. In a buyer's market is where transactions crater. It just gets easier and easier to find that motivated seller. And you always make your money on your buy, right?
Always.
You want to buy from a don't wanter. They don't want it anymore.
And the terms, to your point, I mean, the terms are even more important than the sales price oftentimes.
Agreed.
So you've got to be really careful with your outlook of where you think rates are going to be. But if you can lock in low interest, long-term debt, I didn't do DSCR loans in the past, and that's something you've done more of than I have. Mostly because I've done mostly commercial, and most of those DSCR loans tap out at a 4 unit. Some will go up to about an 8 unit. But there are private lenders who will do commercial property. And so even if you're paying a little bit higher interest rate than you could at a bank, you can lock in loans for 20 to 30 years, even on small commercial properties. And so you've got to lock in these rates longer term. And what I've done in the past is I had some banks that would lock in for 5, 7, or 10, but I didn't ever pay the extra, quarter point, half a point to get the longer term, Now, when rates go down, I'm going to go to many more private lenders, DSCR lenders, and even regional banks, and just pay a little more up front to lock in that 10-year plus term. And that's where you're really going to protect yourself from some, possible economic volatility or uncertainty in these things happening. So don't get a great price and then go get a short-term loan. That could be a big mistake, especially if we think inflation is going to be higher in the future than it may be over the next 2 or 3 years.
Yeah. So we got a few minutes. We might as well pivot to the election. We're 7 days away from the election. I don't know about you, but I cannot wait for this thing to be over one way or the other. I don't care. Let's just get past this. It's really hurting our economy.
Yeah.
But I don't think we've had this conversation. One of the things that we've heard Trump say a lot about, and again, I think this is more, election talk than what will be reality. But it sounds like, he's pitching the idea of putting, 100% tariffs on everything that's imported and things of that nature. Let's just play for a minute that happens. Do you see that as inflationary? Do you see that as encouragement to create manufacturing at home? How do you think of tariffs of that magnitude?
We had tariffs on China and they really didn't make that big of a difference on our prices, surprisingly. So nations that rely on exports, when Trump had tariffs on China, for example, they just paid the tariffs and really didn't significantly pass through that cost on to us as Americans. That may be different this time if more of the economy is hurting globally. They may start to pass some of that on, which is inflationary, means that we have to pay more for goods that we import. However, it kind of comes back to this whole build back better, even though that was a Biden thing. If we're going to start building infrastructure here, bringing reshoring back, which both parties actually want reshoring. They play the good guy, bad guy all the time, but it's pretty bipartisan that they want to reshore things that we rely on from, especially countries that maybe don't have our best interest at heart. So, for example, a lot, semiconductors and a lot of the components of pharmaceuticals, they're trying to rebuild here as well. So I think that, tariffs in and of themselves are not usually great for us, but they're not really that bad for us either. And I'm not an expert on this, but I've just heard a few videos, of this discussion saying that generally speaking, it really doesn't hurt us that much if the nations depend on us as being their largest buyer. It's never great for international relations, but it could be something that could be done that I don't think is going to have a significant impact on us. I think it more kind of goes to the, how cold does a Cold War get before people that don't like, countries that don't like us, that we're imposing tariffs on, are really hurt enough to do something about it. And that's a question that I don't have the answers to. Yeah.
Again, I think a lot of election people, both candidates are saying whatever they can to get elected. I think that's the goal of this part of the process. I think when this, if this goes into practice, I think it'll be far more of a scalpel than a sledgehammer, right? Or a chainsaw. So I think there's a lot of good that tariffs could do if used appropriately on products that we want to kind of invest in and bring on shore. Let's go to the other side, just so we can be equal on both sides. Harris has talked about increasing the tax deduction, I believe, for starting a small business. I think currently it's $5,000. She's talking about going to $50,000. What do you think that would do to spawn more small businesses, more solopreneurs, more people taking their own, futures in their own hands? Do you think that would have much of an impact?
Not if you have commensurate raises on taxes and the tax brackets to small businesses and the middle class. And so they can say, yes, we want to give you incentives here, but somebody has to pay for it. And who do they raise the taxes on? Corporations, small business, above average income earners. And so, again, the Democratic Party, and this is just, the reality, tends to create more programs for those that are lower to middle class, but then they tax it and pay for it from those that are the business owners. And so usually that creates some slowdown in productivity, and it's actually usually bad for small businesses. Where on the other side, the incentives are usually at the larger corporation level, hoping that if they cut taxes, people will invest more in businesses. They'll invest more in their communities. They'll have the incentive to bring a better quality of life to that particular area or sector, which will trickle down and result in higher wages and things of that nature. Neither side does it very well. I mean, that's the reality. Why when it comes to fiscally, I'm really a moderate and independent, because I see that really over the long term, there's not a substantial difference in spending and its impact on inflation. It's just that who benefits. Honestly, the wealthier benefit ultimately under either side. It's the reality, because they find more loopholes, because there's always tax incentives. And whether you're on the left or the right, the tax code benefits those that have the ability to create production in society, if they find the right loopholes. And so I'm kind of like, either way, in terms of fiscally, none of it works out great. But I don't think that spending money and giving incentives is really the answer. I think we need to spend less and let the economy and capitalism work the way it's supposed to. And people can start businesses and they'll do well or not. And that's a real free economy, has less government intervention, because once the government intervenes on either side, it's just fact that productivity goes down versus free capital markets.
Very cool. This is always fun, Anna. Thank you for being here. If somebody wanted to follow you, they need to go to AnnaKellyInvesting.com. Is that correct?
That's right. So you can go there to see opportunities if you're an accredited investor, if and when I have something, and also for coaching and consulting. So I'm spending a lot more time helping people review deals that they're looking at, trying to help them poke holes, looking at PPMs, trying to help you figure out, like, where can you make money in this economy, and what might be right for you given your skills, your money, your risk appetite, and things of that nature.
Anna, you're amazing. Again, folks, go to AnnaKellyInvesting.com. Thank you so much.